Every founder has this, but like if you don't feel like your startup has died 3 times, right, you're probably not running a startup. A lot of times I see founders trying to do this perfect business model, and it's like, you should start with, can I pay you to use the product? If I can't pay you to use the product, there's no scenario that you can charge for the product. And you get this complicated, like, oh, let's figure out this end state. And like a lot of things change. But the core thing is there value? Will someone use it ideally for free? Ideally, then pay you. You want them to pay, but like if you can't get it to free, you're not going to start with like, today's the day that you're just going to pay. I mean, so we did 1 million in about 6 months, and I think we were doing 7 million in a little bit past a year. I think founders have to be 60% good at everything. Product was a great example. I would be on every single call every day. We had 2 stand-ups. Obviously not good enough to scale it, but good enough to get it off the ground. I did the UX, I did the UI, I came up with the logo, the lion, like you do everything and just keep it moving. It doesn't have to be perfect. Don't overthink it. Just get to the next stage. I had a very different philosophy as a second-time founder on seed round. I wanted to have as many people as possible because then they are invested in the outcome of Jeeves.
That's product market fit.
Product market fit.
Product market fit.
I called it the product market fit question.
Product market fit.
Product market fit.
Product market fit. Product market fit.
I mean, the name of the show is Product Market Fit.
Do you think the Product Market Fit show has product market fit? Because if you do, then there's something you just have to do. You have to take out your phone. You have to leave the show 5 stars. It lets us reach more founders and it lets us get better guests. Thank you.
Dileep, welcome to the show.
Thanks, Pablo. Great to be here.
So excited to talk to the journey. I mean, you're on your certainly at least second startup. Maybe you had a few more, but I mean, we talked a little bit earlier. You had one before Jeeves, which is the one you're on right now. That's raised like over $250 million that you sold for over 100. So maybe let's start there. Like, obviously that'll tie into the origin story for this company here. So tell me a little bit about maybe your background and certainly like your previous company and what that was all about.
I'm an engineer by training. So I have 2 engineering degrees a long time ago. Right now, I wouldn't be as good on the engineering side, although it is cool seeing all of the stuff with AI where I actually feel like I can start pretending like I'm dangerous. And then I went to Stanford for my MBA, and after that started a company in the marketing automation space. So very different time, probably about 10 years ago. And we raised about $18 million from a lot of investors, and we exited that for about 106. And the goal of that company was really to provide a marketing automation inside emails. When you open your email, how do you match the person to the content and so on? And then Jeeves, which is my company now, is just in a completely different space. We're building the first global business bank. So think of it almost like a B2B Revolut. But a lot of the lessons that I learned from my first company, Power Inbox, was the stuff that, got me to where I am today with Jeeves. Still a long way to go, but it's one of those things where the lessons, keep propagating from the first startup.
So we'll get into Jeeves, but I'd love to learn a little bit more about Power Inbox, your last company. Marketing automation, that's kind of the high level. Like, what exactly did you guys do?
Yeah. So if you think about what Google does on the web, we did something similar in email. So think about if you're a Starbucks and you want to reach an audience that's, upper middle class professionals in New York. How do you do that in email? So we would do the matching of the content, the targeting of the person. So basically ad serving infrastructure and then the automation that comes with that. The issue was that space just wasn't that big. It is one of those things that you also learn, investors keep talking about the TAM, and the market was just not that big. And we were one of the top players. There were about 2 or 3. We had decent amount of market share, but the scale was just not there. And so we eventually exited that to another company that was doing something similar on the web and wanted to get a play in the email space as well. So just very different from where we are today. But it was one of those things where it's interesting because I don't think I woke up one day, I'm like, oh, you know what I really want to do is solve email marketing automation. But it's one of those things where I knew I wanted to start a company. And I actually started that company with my brother, which is also a very interesting experience of working with someone that's family, someone you trust. And, there are things that you learn from that as well. So,
do you recommend it on net?
Yes. I think the biggest thing with founders is you need someone you trust. And the thing you have with family, good or bad, is usually that trust. The flip side is a lot of your relationships start skewing into work. Everything becomes like a work component. And it's pretty funny. We, given your brothers, you'll still have these things where, my mom would give me a call and I'm like, why are you calling me? Like, you don't even know what we're arguing about. Like, but it's like your family. It never changes. And again, just to be clear, we also raised from like Battery Ventures. It's a venture funded company, went through Series A, Series B. But, the founders, at least for Power Inbox, was originally me and my brother.
And just so I understand, you would help like Starbucks segment their own email list, or you would provide net new emails to them to market to?
Yeah. So think of like CNN sending a daily newsletter, top 5 news items this week. In that newsletter, there'll be a top ad and a bottom ad. That ad they would sell to Starbucks and say, Starbucks, look, you want to reach our audience, you can get the ad. The people that would provide the infrastructure for them to find those people, that was us. So similar, very similar. And Google's obviously massive operation that does the same thing on the web, and web is like 100x bigger, but like the same concept, which is how do you use the content to find people, and then you're matching the content provider, which is CNN, with the advertiser, and then ideally the end user that wants to see the ad.
When did you sell that company?
That was in 2022. So that was in 2022. I had already left to start Jeeves, so I wasn't there for the last 2 years or so of the company. But yeah, that was right after COVID.
Were you CEO of that company, or was your brother?
I was COO of the company. We actually merged with another company that the person running that company became the CEO of the combined entity.
And how did you decide? I mean, it's a big deal to leave a company where you're, kind of a C-level founder type of. Why do you decide to leave that company to start Jeeves?
Yeah, that's a really good question. I think there's a few things you kind of need to balance, right? One, I was getting to a point where I wasn't really learning a lot, in the sense that we had a good operation. It was running well. We were making money. We were profitable. But one of the things I really tried to push myself on, and I see this, founders, is your time is your most valuable asset. And, there's time periods where you feel like you want to go all in. And then the same periods maybe when I'm older and I'm like, hey, this is not my cycle of working 100 hours, that I don't want to do it. But at that point, I wanted to, just like, Jeeves is a 20-hour a day, full throttle kind of business. But I wasn't learning at the velocity that I wanted to learn. Like the curve of learning was really flattening because it was just a well-run, sustainable business.
Was it at scale, or what? It was doing kind of tens of millions in revenue sort of thing, like size-wise?
Yeah, it was north of that. It was north of 50 million at that point. And so it was at scale, well-run business. And then, it just didn't have the same challenges, good or bad. I've learned some people like they just like the part of the challenges. And so I didn't have that. That was one. And then two, honestly, the space, if I'm being completely candid, I was getting a little burnt out on the space itself, where I was just like, I don't know if I want to do this for the next 15 years of my life, right? And thankfully, I had the ability to kind of think through other areas. And it was a little bit of an open slate. And I get this question a lot from founders, which is, how do you decide what to do next? And there's no good answer, but like I looked at probably 8 different companies, like starting 8 different companies. One was in the health space. One was, in kind of financial infrastructure, right? A little bit different from Jeeves. But eventually this is the one that kind of clicked. And it's a little bit of like, what do you feel like you can contribute that's special? How big is the actual market you're solving? And then is there some special timing component? COVID was one of them that is pushing kind of an output for what you're trying to build. But it was a little bit of like, I knew I wanted to start something again. I just didn't know what. And so it took me maybe about a year of thinking through options before kind of deciding on Jeeves.
Yeah, walk me through how you end up deciding on Jeeves. You mentioned some of the elements that you thought about, but maybe just more the specifics, because what you decide to start is a huge determinant of where you could possibly end up. And a lot of times, especially for first-time founders, it's funny enough, maybe not given enough thought. A little bit like your first business, which obviously was still successful, but it's like, I just want to start something. This thing happens to me in front of you, so you go and you do that thing. And in some cases, good cases, you end up with a solid exit. In other cases, you waste 5 years of your life running down a path that leads to nowhere. Like, what was it about Jeeves that pulled you in relative to the other things that you were thinking about?
Yeah, so it's a really good question, and I think you have to find a few things that you really like about what you're trying to solve. So what I'm trying to get to is you need to at least fall in love with the problem, independent of the solution. Like it should be something that you personally care about, and it could be anything, but it's at least something that like it's intrinsically motivating to you. Like you want the extrinsic motivation, you want to raise, you want a good outcome, everybody does, but like is that challenge something that you are motivated to solve? Because if it is, it'll push you through a lot of things that someone that's not intrinsically motivated would get stuck on. And like I'll give you an example. I looked at something in the health space, and I looked at it for about 3-4 months, and I just got to a point where I'm like, I'm just not that excited about this problem. Like, and it took me 3 months. Like it took me 3 months of like, I talked to people. It's like, okay, what does this look like? Let's set it up. Let's beat it down. Is it still standing? And then when it came to Jeeves, that was one where 3 months in, 4 months in, beating it down, I'm like, this is interesting. And like from an intrinsic perspective, I'm like, how do you solve banking for a company that's doing it in 3 countries. Like, how do you solve it? That's the problem. And then you kind of build all these things around it. But like the core thing was something that was very intrinsically motivating for me in a way that a lot of the other ones were not. Like, there's no blueprint for it. I literally, like, I had a spreadsheet. I was going through ideas, kind of like, okay, is this something I can contribute to? Is this something that's, just a good idea? Like, I'll give you an example. I looked at one in the IBF space, which is a really interesting area, very fragmented. People spend a lot of money. Everybody wants a good outcome. You're motivated to have children. So like you have kind of buyers that are motivated. But it just wasn't something that I knew inside out, and wasn't something where I'm like, oh, like I can spend 10 years of my life doing this. And I think people forget how hard startups are in the sense of how much time it takes to even get to like an outcome that's just a, decent outcome, not a big outcome, but just decent. Because you see these big companies, and we also did that, right? We raised 3 rounds in 12 months. We raised $250 million in 12 months, right? Like it happens, but that's not the outcome. That just gives you the fuel of what you want to build. And you really and it's been 4 years since we're still building. You have to put in the time, and you have to find a problem you're excited about. And I have this thing that I've heard, and it really resonates with me. It's just you have to fall in love with the process of building and not the outcome. Because outcome might come, it might not come. You don't know. There could be things that change. So the regulations change. You build this for 4 years. Now Bitcoin is crazy. Nobody wants to touch it. I mean, that's happened, right? And then 2 years later, it's like, oh, we love Bitcoin. You didn't control that. But you have to enjoy the process of building and not the outcome. And if you enjoy it, more chances than not the outcome will come because you have enough going that you'll push to get that outcome.
And tell me a bit about the idea for Jeeves. Like, how do you fall into this world of banking in general, and specifically like multi-currency, multi-country?
Yeah, so a few thoughts there. So one, Jeeves by nature is a global company. So we operate in 25 countries. We provide business banking. I had no banking experience before this. And I think that's one of the reasons I looked at it as, how do you do this at scale in 25 countries? Because if I did, which I do now, I would realize how complex it is and how much regulation and compliance and, it's banking. It's not like you're just like doing a SaaS thing and just like turning the wheel. Like it's a full operation. You need to have compliance, regulation, etc. But sometimes that naivety is a good thing. The fact that you're an outsider is a really good thing because you don't look at it the same way. If I had 25 years of banking experience, I'd just be so coded in a certain way of like, well, this is deep. I can't do anything more. Let's just do one country, then add another. And because you didn't have that, because you were an outsider, it actually gives you a huge advantage of how to think about things in a different way. And so just going back to the question, my last company, we operated in 2 countries primarily. And in those 2 countries, we needed 2 different corporate cards.
US and where? I assume it's US and another country?
It was US and Israel. So we had 2 different corporate cards, 2 different bank accounts, 2 different payment rails. It would take us 30, 45 days after the month closed to know our cash position for last month. And that's very normal. I mean, that's just how businesses operate, right? And so if you want to solve that, the core part that I was realizing is you really need to own the infrastructure, because otherwise everything is in a silo, and the silo is then locked in one country, in one currency. So it's not just a silo, it's a silo in a box, in a rhythm. It's like 3-4 layers just to get the information out. And the only way to solve that is you have to have an abstraction layer that sits on top, which is really the core of what we're building, which is just, I can go very deep into it, but if you think about like card issuing, for instance, we do a lot of that issuing directly. So the transaction data sits with us. That's the crux of what we're trying to solve. But it is a big, very hard, challenging problem because you have to build infrastructure at scale.
Yeah, let's maybe take a little bit tangent just on the context in banking in general, because global and remote and stuff has like made a lot of this stuff maybe more top priority for people. Maybe my first question is, Deal is another company that's not a banking company, but more on the payroll HR side. But that's how you would think of, like they're solving the, you have employees in different places. You're solving that you're taking money from different places. Is that a good way to think about it? Simple terms?
It's exactly that. Both are coming on a central thesis that companies are going global faster than before. And it's almost the default now. Companies are global by default. So that's the thesis. And then amazing company coming at it from the aspect of payroll, which is core. And we're coming at it the aspect of banking, which is also core. But it's a different side and at different pluses and minuses, and they're built in amazing business. But yes, the core item that you're trying to solve is exactly that. Companies are going global faster. They need to have banking infrastructure that's global by design. Today, banking by design is country specific and currency specific. How do you solve that?
So then moving into banking, even if you bank with, let's say JP Morgan, right? Like some massive global brand, you still then, but if you're in different countries, you're going to have different bank partners in each of those countries. Is that like the status quo before something like Deal?
Yeah. So just think about like a company that uses us in, like we have this company called Hotmart in Brazil that uses us. They use us in 9 countries. In those 9 countries, they only have one expense management provider, us. They don't have one for US, one for Germany, one for Brazil, local language speaking for Spanish. Like it's just one. They only have one payment provider. I mean, I'm sure they use the banks, et cetera, but we become their operating kind of system that we provide. And so one login, you see all of this information, you get all your card.
This is on the expense side or also on the transactional side?
On both. So we provide full banking services for cards, which is our core flagship product. It's expense management, employee spend, etc. Then we added payments. So you need to do local and international payments. So think about AP, which is actually a much bigger box of spend than cards. Cards is a small component, but it's a good wedge to get in. But AP volume is 10 times bigger than card. And then we have started adding deposits. And in Brazil, for instance, which is one of our key countries, we cover 25, we are filing to become a full bank by next year as well. So really, again, just going back to the thesis, it's how do you do business banking at scale? How do you build a global B2B Revolut? And our target is companies that are enterprise companies that operate ideally in more than one country.
But to be clear, the status quo before something like Jeeves would have been you have 9 different banks. You're in 9 countries, you have one bank per country.
You have 9 different banks, you have 9 different card providers, you have probably different AP, because each one is a different currency, right? So like if you think of Bill.com, really Bill.com is a US-centric offering. Like if you were using this in India, you don't have Bill.com there. It's not going to work in India. You need to have an Indian version of Bill.com, which is there. There's absolutely a company that does exactly what it does. But you have to go cobble that together. And then you have a team whose job is exactly that, which is like, okay, we have 20 systems. How do we log into each system? Get the information, put it into our closing for the end of the month, and then you go to the CEO and say, here's the number. That's the core reconciliation, accounting. How do you do that at scale in different countries? And by definition, it's not supposed to be interoperable because each country is different and each currency is fundamentally different, and payment rails.
It's a great example of one of these like no-brainer situations, right? In the sense that if you think about a company that operates in multiple countries, they would obviously rather have everything in one platform than across 20 different platforms. It's for sure. But you also assume that then, the banks would see that and also solve it. Like, how come things are the way they are? And especially from the perspective of, as you're starting to see this problem and think about it, I'm sure you're thinking about this as well. Like, what are you finding out that maybe they don't know or that you're willing to do that they haven't done?
I think, if you look at companies like Nubank, I think it's a good example of the same gap that we're trying to lean into, which is it's not, banks are always going to be there. We're not going to magically like remove banking's monopoly. I mean, they provide an amazing service. They move capital. You trust them. They're not going anywhere. But there's areas like this where it's really not in their interest to use all of their resources to solve this like very, structured problem of like, how do you do data in these many countries? If I'm a bank in insert country, my goal is to make revenue, profit, be a good partner to my enterprises. My goal is not necessarily to solve this for the company that's in, Mexico or the company that's in the US. That's where startups can be different. And so I don't see this as us trying to, take market share from the bank. I think there's subsets of companies, especially enterprises that are global, that have very specific problems. That's where we can shine for them. And I look at this really as an integrated offering. And even if you look at how we think about the revenue breakout, it's really very blended. It's cards, it's payments, it's SaaS, and then there's deposits. So it has all the components of the banks in that whole like revenue stack.
But wouldn't the argument be that, the biggest companies in the world are global, and then if they deposit with you, then they don't deposit with bank XYZ? So is that not?
Yeah, so it's a good question. So we use obviously our own system. We have 12 employees in 12 countries. We also still use JP Morgan. We also still use Citibank. We keep funds in there as well, right? But our operating system, our day-to-day, that runs through Jeeves. Like there's no scenario that they're just going to be like, oh, I'm going to shut down my bank account. Like that doesn't happen. But think about like countries where we operate like Colombia. You still have to walk into a bank to send a wire. Like you don't have to do that on Jeeves. That's just operational efficiency. It doesn't mean that the bank's going away. They'll still keep cash in the bank, but you can build massive software businesses at scale by providing that layer on top that makes it easier, that makes it controls, right? You put a payment, someone else approves it. That's great. The bank's not necessarily going to go build that because that's not their core offering.
Got you. You mentioned that you would, look at these ideas for maybe 3-4 months at a time. What did you do during those 3-4 months, the first few months where you explored the idea of Jeeves?
I had kind of a little bit of a system where one, I would try to write out just the core problem you're trying to solve. And then two, try to beat the crap out of that assessment. Like just like every possible, like, why is that right? Why, like, okay, why are they not doing it? Okay, like if it's such a great idea, how come no one else has done it? Like what's so brilliant about like how you're thinking about it? Like this completely beat, and not just me, like talking to people. Okay, like this IBF, like it was a really good example where like someone should do it. It's very fragmented. The outcome, you want a successful outcome. Have you been to any of these places? They look like hospitals. Like you're not induced to have a successful outcome. Like all the things you need. But then I'm like, I don't have the skill set to be able to solve this problem. Like someone else should do it, but I don't have that skill set. So I talked to a doctor for like that's in the space. Like, why is it like this, right? So basically, how do you come up with a problem statement? How do you beat the crap out of that problem statement? And then is it still standing? If it's still standing, then we focus on one KPI, just one metric, either revenue, growth, number of companies, signups, waitlist, just one. And see if that number can move. And that's kind of what we did with Jeeves, which is just one KPI. And a lot of times I see founders trying to do this perfect business model. And it's like, you should start with, can you give the product for free? You should start with, can I pay you to use the product? If I can't pay you to use the product, there's no scenario that you can charge for the product. And you get this complicated, like, oh, let's figure out this end state. And like a lot of things change. But the core thing is there value? Will someone use it ideally for free? Ideally then pay you. You want them to pay, but like if you can't get it to free, you're not going to start with like today's the day that user's going to pay. I mean, there are other like models like that, but I'm just saying in the core model, it has to have some intrinsic value that the person's going to say, okay, I'll try it. And so that was my second stage after beating the problem. They're like, okay, this problem's still standing. Jeeves, like the question was, can we get cards to companies internationally? And then can we get them to use those cards? That was it. That was our focus. That was the goal.
So what was the KPI? Like total payment volume through the cards or number of cards issued?
It was number of cards issued and transactions on the card. So basically, and today we cover 25 countries. We have local cards in all 25 countries. We started shipping US cards and we just ate the FX. It's not a good business model, but it shows there's demand. And then I'm like, okay, now let's go get licenses. We have licenses, all these countries. But if I sat and I was like, oh, I can't start until we have card issuing in 25 countries, I'd still be there. I'd still be waiting. Like it takes time to kind of get to this point. So we just took US cards, shipped it to these countries, we ate the FX fee, but clearly it was clipping into a demand where people are like, yes, love it. Like I will take this to people like, can you open this country? We're like, oh, sure. Like let's try this country, right? And so you just have to be malleable as long as you have that one KPI, which for us was transaction volume and number of cards, like one meaning two.
You told me a little about the IBF kind of 3 to 4 months, but with Jeeves specifically, like who did you speak with and what were some of the things that you heard that made you just double down in this opportunity?
Yeah. So taking a step back, if you look at like what we're doing, there were examples of what Jeeves is, obviously in the US, Amex, Brex, Ramp was coming up, like clear examples, clear market fit. The question was, no one had done this at scale internationally. And the reason, part of what I realized from talking to people is if you look at the US, it's a large single market with a single currency. If there wasn't competition, I would just do the US as well. It's much easier.
You would have done Brex, like that would have been the obvious thing, yeah.
That's exactly right. And so now if you look at a company in Mexico and the company is growing, what do? They actually go to Colombia. They actually go to the US. That's how they increase their TAM. Now they have the core problem, which is they have multiple cards, multiple currencies, multiple banking systems. So by definition, the geographical countries we're looking at, these companies that grow, to increase their TAM, they have to go to other countries. So they have a different core problem than just the US-centric focus, which is, again, if they weren't there, we would probably do US because it's just a massive, massive market. And so that became the core part of like, okay, how do we solve this? How do we solve this for a business that operates in Mexico, Colombia, and the US? And then it came out to like, the only way to really solve this is to build some of the stack yourself, right? And so in the beginning, what we did was we focused on, and we were in Y Combinator, so we focused on Y Combinator companies that were operating in more than one country, like startups, and just be like, hey, can you use the cards in both the countries? Like, we'll give you cashback, we'll give you all these things, but like, just is this resonating for you, right? And when we started seeing the usage, the adoption, then we started thinking through, okay, how do we actually go build this in these countries? And I'll give you an example. In Mexico City, the first time I flew to Mexico City was for Jeeves. So it's not like we had some deep background in Mexico City before, but we then hired, our first hire was the GM who was based in Mexico City. You have to hire someone local. You have to hire someone that knows the market. But I don't need to know every single market. I mean, that's not the business that we're building. I need to know enough that I can help push an outcome that the person running the market needs. But in every country, you need someone that's local, someone that's in Colombia, someone that's in Mexico, someone that's in Brazil. I cannot run Brazil from here. It took us a year and a half to realize that, but you need someone that's fully local.
You just mentioned you went through YC. I mean, YC is obviously very well known. A lot of founders want to go through it, but I find it's mainly first-time founders that want to go through it. You'd already had a very successful exit. You've been through the startup world for about 10 years at that point. Why did you decide? Because you do have to give a meaningful amount of equity, right, to get into YC. Like, why did you decide to do it for Jeeves?
So there's a few reasons. So one, again, this is kind of the thing with startups, right? When I was starting this company, this was March of 2020. I had just kind of wrapped up with Power and Docs at that point. I was starting this, and I had talked to a VC fund, and they said, "Look, we'll give you $3 million for 15 million post, and that's it. We'll take the whole round." Like, great, like ideas resonating, blah blah. And then COVID happened, right? And COVID changes a lot of things, and they were like, "We're not able to get there," and it was a little bit gut wrenching. Where I'm like, "Oh, we had planned on this, blah blah." And then you just have to focus on, okay, what is the best option at this point? And YC made a lot of sense. One, because we were going B2B. Like, the product is only B2B. It is not B2C. We're not doing consumer. It's all enterprise business, etc. And then two, there was a lot of uncertainty with COVID, and the fact that you're coming from YC gives you credibility, especially in markets where I'm not native to, right? I'm not native to Mexico, Colombia, etc. These are markets we operate in. Having that brand really, really helped. And then the third thing was that even though I had started a company before, this is a very different space. And having exposure to folks that had that background in fintech was very helpful for me. And so they have been very, very helpful even since that point. But I would do it again. I don't know if I do my third company again, but like I would do that same position again, because I think it really helped change the trajectory of the company. There was a lot of uncertainty. People forget 2020. Like, it was a lot of uncertainty. You didn't know where this was going. You didn't know if COVID was going to be a 5-year thing.
Yeah, there were 2 or 3 months there, like second half of March, April, May, where it was just like, oh my God, is everything ending? Is VC done? Like, our startup's over? Like, it was nuts.
And you have some cycles. It's funny you bring this up, and like I was reading this thing, and every founder has this, but like, if you don't feel like your startup has died 3 times, right, you're probably not running a startup. This is one example. I remember our last round, it was supposed to be funded on end of February 2022, which was, by the way, when the Russia-Ukraine, invasion war, et cetera, started. And that was another whole cycle where, people were just like literally the day of funding, were like, we're done. Like, we don't know what's happening. We're all pencils down. Like, we got to see. And, we managed to get that round through. But like, the thing is, people never see this. They just see the headline. It's like, oh, that must have been easy, but it's never as good as it seems on the outside. It's never as bad as you think it is on the inside. And the truth is somewhere in between. And you, as a founder, have the most information. So you see every single thing, the warts and the pluses, and you have to have that balance. And I do think being a second-time founder, that's one of the benefits of doing it the second time, because it's like, you don't kind of, puff your own like hot air. Like, it's just like, okay, I get it, but like, we still have a lot to do. So
You love this show. You don't want to miss the next episode. Why would you? So hit that follow button. Trust me, it's in your own best interest.
It's funny. I mean, when you start a startup, you think through and you have a good sense of all the different risks and the thing that could happen to your business, but you rarely realize just how many things outside of your business might, be the thing that either completely screws her up or actually gives you a huge, huge tailwind that you never imagined. It's hard to predict.
It's a great point. And one of the quotes I love from, I think it was Ben Horowitz's book, is kind of like just making sure your startup is alive long enough to survive the changing pieces. It's like a game of chess, but the game changes. The game changes next year. Like, AI is a fantastic example. Like, a lot of startups didn't make it to the point to survive with AI. And part of your job as a CEO and a founder is to make sure that you survive and then you thrive because you're surviving. But the game itself changes. It changes every year. I mean, the regulation, the Genius Act, we're doing a ton of things in stablecoin now. We couldn't do that 2 years ago. That it just, like, I couldn't go to a bank and be like, I'm doing stablecoin. They were like, get out of my roof. Right now, it's like, oh, cool. Like, what's your stablecoin plan? What's your, like, I get people asking me this, and that's fundamentally changed. The product technology hasn't changed. It's just exactly to your point. Things you don't control have changed. But now, because we survive, because we're strong, we get the chance to fight again and like put that, new technology in. So a big part is just surviving and like knowing that the game itself is going to change every year.
When do you graduate YC?
Summer, so September 2020.
And what is, we talk about MVP in the context of building startups, like, what is the MVP for something like Jeeves that is fundamentally a bank, multi-country? Like, it's just big by definition.
Yeah. So we had 3 stages, basically. The first stage, which is still our core flagship product, is the cards. basically, how do you do cards in 20, 25 countries? We're full local issuers in Mexico, Colombia, Brazil. And so when we started, that was the core. How do you do cards in these countries that you're covering? How do you even get the cards there? Which, by the way, like people forget this, but usually if you get a card in the US and you're in Argentina, you have to get the actual card to Argentina. So you got to figure out how to ship the card, right? Like it's not like just the cards like show up one day. Like that wasn't also there. We had to figure out how do we do this? We put it into envelopes, get into FedEx, send it to Argentina. Like it's all things that don't scale, right? Like the YC mantra, none of that scales. But it shows that there's demand. It shows that there was PMF.
And these were cards, these are just American cards. You're just paying FX, but you're telling people, hey, you can spend anywhere, you can get it anywhere.
Yeah, US cards work everywhere. It's just not a long-term, like you can't really run a business using US cards because you'll just get 2% fees on everything you do, right? Like which is not sustainable for a business. But you can absolutely use the card. Just like when you travel and you use the US cards, you can use it there. But it was more to do exactly what you're saying, like PMF, prove that there's demand. And then once you prove there's demand, then you start tightening things around it. Okay, you've shown that there's demand. Now can you show that you can do this with locally issued cards? Okay, you've shown this locally. Now can you do this without cashback? Okay, you can do it without cashback. Now can you show that they'll pay you for this? I mean, that takes 2-3 years, right? Like it's not like one day, but like it's a sequence. It's like if you don't do step one, you don't get the right to try for step two. It's like a Mario Brothers level, right? You don't get level 2 if you don't get through level 1. And level 1 is just basic. And then level 2, like it gets more and more advanced.
Exactly. So but to be clear then, your first MVP, let's say, was just like cards anywhere. And that was kind of the like Brex for anywhere.
Yeah, we started with about, I would say, all of Europe, UK, Mexico, Colombia, Canada, US. So we didn't have Brazil when we started. We added Brazil a little bit later, but we still had, 20 plus countries. And the goal was exactly that. Can we get cards to these countries?
And these are credit cards, debit cards, both?
Charge cards. So 30-day, very similar to like basically we would give you credit for 30 days and only enterprises. And then at the end of 30 days, you'll pay us back. So if you think about that, one of the things we have to solve is how do you actually underwrite the risk of these companies, right? Because you're giving them 30 days of credit. Like how do you get them connected on a Plaid equivalent in these countries, for instance, so you can see what's in their account. And so we had 3 rules for countries we wanted to operate in. So one, do they have what we call fintech V1, which is ability to look at bank accounts, open banking. There's some way to reduce the risk so we know what we're looking at because some of these countries, like it's the first time we're operating in Colombia. Like how do you assess risk? So that's one. 2, is the government opening up to fintech? Like is there regulations that's moving in that direction? Brazil's a great example. I think they're very forward thinking in how they look at working with fintechs. And then 3 is their capital flow. So like, is it like US, Mexico, fantastic example. There's capital going back and forth. They need this product. If you have all 3, it gives you a lot of breathing room to make little changes if one specific thing is not going in your direction. And I think one of the things that we, good or bad, by chewing such a big problem have in our benefit is that it has a lot of complexity, but it also has a lot of levers. Okay, one market is tightening, you can open up the other market with more fees. Or this fees is tightening, okay, let's add payments. Like you're not just doing cards in Mexico and then Mexico changes some rule and the business could go down, right? You have these multiple levers, multifaceted business that you can kind of play with. But yes, to start, it was exactly what you said. It was cards. In these countries, we ship the cards ourselves. A lot of it was YC companies, which, is one of the other benefits of YC. You get a inbuilt kind of PMF.
Were these like YC in your batch, like very small, or was there a way for you to access the true like at scale YC companies early?
In the beginning, it was small. It was, and some of them even to this day still use us. But it was really like folks in our batch. Hey, like this is kind of a service.
Tell me about that, because I mean, a lot of the small companies that are YC based would start selling B2B SaaS at that time in the US, right? So like, What were some of the companies that would have used you in all these countries?
So we focused on companies that were based outside the US and not necessarily just our batch, to be clear. So for instance, we would look at like, have there been companies that came out of YC that have HQ in Mexico? Because if they have a headquarter in Mexico, they can't be onboarded by a US expense management provider because you need a US entity for that. So by definition, there's a gap, right? And so then we'd be like, hey, here's what's unique about what we can do. We can onboard a Mexican entity. We can onboard a Colombian entity. We can onboard these entities and like give you cards against that, right? And so that was kind of the difference to start. But we started small. I mean, it was not like, today we have, BMW, Lululemon, H&M, like obviously we didn't start with that. We started with companies that still use us today, like Belvo is an example. They're a YC company.
And was that first product, was there a UI like a Brex type UI for expense management? Or was it really just, hey, now you don't have to pay FX when you've got your card, so you can at least like do stuff?
Good question. So we definitely had a UI, and I think I've said this to our team. I think founders have to be 60% good at everything. And product was a great example. I would be on every single call every day. We had 2 stand-ups. Obviously not good enough to scale it, but good enough to get it off the ground. I did the UX, I did the UI, I came up with the logo, the lion, like you do everything and just keep it moving. It doesn't have to be perfect. Don't overthink it. Just get to the next stage, right? And so, yes, we had a UX. I mean, this is a great example. Like we actually, because it was such a complex product to start, like we had to get outsourced help to help build it. Because I like, think about it. How can I hire 5, 6, 7 engineers when we are 2 people? There's no budget to even do that. Like, so you either say, I can't do it, or you figure out a way with the budget you have, right? And so obviously the product's much, stronger, stable, all of that stuff. But in the beginning, it's just, you had a login. It was functional. You saw your card transactions. You had your limit. You had some very light analytics. And then that was it. And it just told you like what you're spending on. You see it in there. We did have right from the beginning the virtual cards, which was the ability to create cards, freeze them, unblock them. That was a fairly big delta in some of the markets we're operating in, like in Colombia, Mexico. That wasn't as common. So that was a big differentiator that we did have from day one. But we tried to keep it as functional as possible in the beginning.
By the way, in terms of market size and just trade, I mean, Mexico, Brazil make a lot of sense. Why Colombia?
Yeah, so Colombia is interesting because a lot of the companies that we operate with there tend to be actually larger. So they tend to be public companies more than even Mexico and Brazil. And again, like I don't see us replacing the banks, but I think just from an operational perspective, you get to punch above your weight. And I think that's one of the benefits of where we operate. Because if we were in the US, you'd be slotted in as like your mid-sized, here's your CAC, and here's the small segment that you can play in. If you want to go above that or below that, not happening. Whereas because we get to operate in Mexico, Brazil, Colombia, all these markets, we get to punch above the size of the company with these, very large companies that we wouldn't be able to do in the US. So for us, it was both Colombia itself, but also, again, going back to the original thesis, if you're a Mexican company and growing, you're going to end up in Colombia at some point. And then to service that Mexican company, we need to cover Colombia or vice versa, right? So it wasn't just like Colombia itself. I kind of call it like a network, right? So the value of Jeeves is better the more countries we cover, because even for that company in Mexico, now we cover Spain, big corridor, Spain to Mexico. We cover that. We can give you a card in Spain. Your founder lives in UK. We can give him a card. Like, so it becomes more valuable the more countries you cover, because the core product is almost like an exponential value every time you add a new country.
So you use the YC network to kind of get the first few customers, you issue some cards, and then what happens? Like, what do you see in terms of usage?
Yeah. So it's interesting because I call, PMF is like one of those things that you can come up with all these definitions, but you know it when you see it. If you don't know it, you probably aren't seeing it. Like it's as simple as that. And like, it's like all this like, growth rate, all like, it's basically you're growing so fast that you can't keep up. And like you're trying the best and it's a great place to be in. And again, there's a lot I've also learned about PMF, right? Which is there's the initial PMF, then there's but now we need actually a growing business, and then you start turning things off. And so you're typing the PMF. Then it's like, is this the PMF with the right customer that you want? Because you could have PMF with different customers, and maybe some of them is a subset you want to grow with. And so you have to also like take a little knife and cut down your PMF. But the initial part that we were seeing was a classic PMF curve, which is, we were just seeing usage. People couldn't get enough of it. Like it was just like the spend was growing 10, 20, 30% monthly. We were adding revenue. Obviously, the revenue is upside down. It's not profitable. But PMF is clearly there. And it's almost to the point of like, well, the product is good enough, but clearly we can make this product 10 times better. So the fact that it's working so well is because there's market demand. And that's one of the big advantages I think we have even today, which is because we cover so many countries, the demand for this type of product is high because we cover a lot of surface area. So you're not like stuck in one region with one kind of offering. And we saw that from day one. And we just couldn't really keep up in the beginning. But I'll give you an example here. Like this is the thing that like, I think in the beginning, founders get stuck on a lot of things. We started with cards, and then I remember our card provider wasn't ready at that point to go live. So we were basically using kind of the testing thing, and we were like testing is like maximum, like, I don't know, 100K of volume we were going past. And they're like, we are going to have to turn you guys off because it's not live. It's a testing program, and it's clearly, more volume than we're comfortable with for testing. And we're like, okay, we need to move to another provider. And so, I was challenging the team to do that switch in 1 month. This was December. Actually, I remember now, it was December of 2020. So exactly 5 years ago. So we had to turn off cards, switch to another provider. In between, we still had 60 days of like, we need to figure out what to do. And so we came up with this product, which is today about 40% of our revenue, which we call Jeeves Pay Credit. So basically, you can use our credit line. So let's just say you come to us, you're a BMW. We say, you're a great business. You're doing banking with us. We'll give you $2 million on a 30-day card spend. You can now use that 30-day card spend for payments as well. So accounts payable. And we ran that off of a spreadsheet, like just completely off of a spreadsheet.
Just walk me through a little bit the difference just here in terms of AP accounts payable and just normal cards.
Yeah. So cards is basically you get a corporate card. It's primarily used for travel expenses. So, dinner, you're going to a restaurant, you're taking a customer out. Like that's kind of the core use case. Then the second box that is used for is really central spend. So AWS is a good example, Facebook ads, Google ads. Like those are the big categories. Cards used for that. AP, which is a much bigger box, is usually vendor payments. You need to pay anything else. You need to pay your rent. You need to pay for, I don't know, you're an e-commerce provider. You need to pay for just anything else.
It's typically bigger ticket items.
Bigger ticket, lot of volume. And then if you think about it, they come to us saying, hey, we want to start with you on cards, but really what we're trying to solve, what we Jeeves are trying to solve is we want to be your hub for all spend. So it's spend management, right? It's not cards management, it's spend management.
Because otherwise you got a vendor in Colombia, you got to take it from your bank in Colombia, move it there. If you got another vendor in Mexico, you move from Mexican, whatever there, like, and then US, USD, move it there, like, and you're just doing all the stuff and then you're reconciling and you're, oh my God, we have a lot of money, but the Colombian bank has no money. So now we got to wire money over to the Colombian bank, like.
Exactly that, right? And so we started with the cards, which is still, the core kind of product. But because we had this gap where we had to shift providers, we wanted to do something in that gap, right? And so like basically not just shut down the product for 6 or 8 weeks, like nothing, right? So that would go to zero. So basically what we did is we launched this product called Jeeves Pay. And today that's about 40% of our revenue. And today it's fully integrated. It's like accounts payable. You can go in, we connect, for instance, to the tax authority in Mexico. We'll download all your invoices. You click a button, we'll fill it in. You can send it out. Full accounts payable. We charge for that, right? It's a SaaS product at this point. It started because we had a 60-day gap where our cards were turning off. And we were like, well, we have to do something. Okay, what if we try this? And it was all on spreadsheets. And what I'm just calling out there is in the beginning, you kind of are like a jack of all trades and you kind of have to just figure out how to make it work. Even if it's, like, think about it. Like someone basically said, we're turning your cards off, go find another provider.
And how did you do that, by the way? Like, how did you lend that money out at that point? Like from where?
The capital it comes from our own, like in the beginning, it came from our own equity.
It's just balance sheet. Okay, just because you had raised some money.
We had raised about $4 million, I think, on our seed round. So it was basically, that's how everything starts. You're not going to get a facility in the beginning. Now we have a fairly large facility. We're doing 3 billion TPV. Like it's massive. And you can't do that off a balance sheet. But in the beginning, it's just, it's 100K, right? So you raise 4 million, you're just rotating the 100K or 200K, whatever the number is. So it comes off of that. But the product itself started changing from cards to cards plus payments. And today, it's one of the benefits of us doing that so early. We're one of the few companies that shift is almost even. Whereas if you look at other companies, even ones in the US, it tends to be very interchange heavy. And our business is not. Our interchange is probably less than 50% of our revenue. And payments, which is core, is another 40%. And then SaaS is another 50%. So it's a very blended profile because of some of these, you want to call them hardships in the beginning, because that forced us to think through, okay, what else can we offer? Now it's a big part of the offering that we have.
Tell me a bit about your seed round. When did you raise it and kind of how did that happen?
Yeah, so this is also a good point. I had a very different philosophy as a second-time founder on seed round. I wanted to have as many people as possible because then they are invested in the outcome of Jeeves. It's got positives and it has negatives of doing that, right? And so we had one lead urban innovation fund that put in about $1 million out of that. I think it was 4.5, if I remember correctly. Everything else was small checks, and you have to do a lot of work to manage it. So some founders don't like that. They're just like, give me 2 people, clean cap table. That's awesome. But the way I was looking at my business, I need to grow in 25 countries. The more people that are invested in Jeeves outcome, the more likely I can, use them when I need help, right? Where I'm like, hey, can I get an introduction here? Or we need to talk to the central bank in this country. Like, someone there. So my philosophy was to get a large round with as many people as possible for the seed. And then the second thing, and this is something I learned from my first company, is just how do you construct the cap table, which is basically you want to have someone that has potential to lead your next round in the round before, even if it's a small check, because what you want to be able to do is give them insights into how you're doing before you go to them for the next round. And the one thing I've noticed with investors is basically you tell them, hey, we're here, our goal is here. Then come back and say, now we're here, our next goal is here. Come back and say, now I'm here, I'm fundraising, next time I come, I'm going to be here. That's when they take it seriously because they've seen you do it 3 times in a row, right? And the only way that works is, one, you can send this, massive blast, but you give few people like a select kind of preview. And if we look at our Series A, B, etc., we had the folks that did that on the cap table in the prior round. And so like Andreessen Horowitz did our A. I mean, I talked to them for 1 year. I talked to them from the YC A's to the seed.
Were they investors in the seed, or you just kept them?
No, I had known them from pre-YC. So pre-YC and then the seed and then the A. But then the person that did the B, I had talked to right at the A. And then the one that did the C was in the B. So it's almost like a cascading thing. Like you can't go the first time and just be like, hey, we're here, like give me like $50 million, right? That you need to have that build up of like, hey, I came last time here. And then they feel like, oh, this guy, or girl is like doing what they said. And next time they come, I'm going to pay a higher price because they're clearly delivering, right? If you show them you can deliver, then the value of what you're saying is high. And then the next time they'll feel like, okay, when he comes back after this, I'm just going to pay more for the same company. If you're interested. And if you're not, that's fine. You can just say, I'm not interested and move on to the next one. But one of the lessons I learned from my last company was just how to think about cap table creation.
Tell me a little bit about go-to-market and go-to-market tactics. After the first few companies that you land from YC, what is the main thing that you use to acquire customers? What works best?
Yeah. So because we covered these regions, my first hire, and just so you can step back, if you think about just infrastructure, how we're set up, right? If you think about a card stack, there's 4 components. There's a top of the funnel customer acquisition, kind of go-to-market. There's a processor. There's a program manager, which is regulation and compliance. And then there's the BIN, the bank identification number. So the numbers on your card, that has to be local for each country. What we do at Jeeves that's very unique is the first 3 sit on our own stack using different partners. So when we go from Mexico to Colombia, we only need to change number 4, the BIN. If we go from Colombia to Indonesia, which we don't cover today, we'd only need to change number 4, the BIN. So it's a different model for a lot of fintechs that go very deep in one country. But the flip side is we are very local for anything go-to-market. And so the number 1 hire we need to do in each region, and usually the first one is what we call the GM, the general manager. And they are, really kind of the owner of the region, but tend to be very sales-focused. They're running the customer components, anything that touches it. And that was the hire that we did for Mexico, Colombia, fully local person on the ground. And then we started looking at what's the most cost-effective way to grow the base that we had. And part of what we had, I think that was very successful, is we had very strong word of mouth in the beginning because the product that we were offering, there was a real gap in the market. And like you brought up Colombia, there weren't any other players in Colombia. And so, if you're offering a product that doesn't require going to a bank for 4 months to get approved, it's got demand. Like people will tell people, and then they had a wait list, and the wait list was just signing. I mean, we had tens of thousands of companies on the wait list. And so that was a big, big driver. And then the second thing that we did, which was very creative then, and I still get a lot of folks talking about, is we would go try to find areas we could put banner ads, not digital, banner ads that were cost effective. And even today, if you go to the Mexican airport, you'll see our ads when you come in. And we've had that for 5 years. And it is incredibly cost effective. Like I don't want to share how much it is, but it is so effective compared to what you would pay for something else. And think about it, you're a bank. Now I get people saying, hey, I saw you at the airport. You guys must be big. We're not that big.
How do you even measure attribution, by the way, for something like that?
It's the trade-off, right? Like you don't know fully, but just the brand. Like I look at it more as brand awareness, which if you're fintech, if you're doing banking, it has a lot of value. Even if it's not directly CAC attributable to like they saw this and now they clicked on it. The fact that people see you in the ether, it goes a long way. But just as an example, in these airports, we would go in and say, hey, that wall doesn't have anything on it. Why don't we take that wall? Not, let's get the number 1 billboard that you have that you're already getting 5 other people competing for. It's a wall. Why not get extra cash? But you have to think about that in a little bit of a different way. And so we were looking at these angles where we're like, okay, how do we get placements? How do we get traffic in a way that increases the brand? And then overlaying that with some of the word of mouth that we had, especially because we were operating in countries that didn't have a lot of this, product offering before we came along.
And when would you say was a time when you'd felt like you'd found true product market fit?
Yeah, that's a good question. I think as we got into probably a year, like a little bit less than a year, so like 6 to 8 months, I think that's when we were starting to see companies that we wanted to grow with coming to us. So in the beginning, you're a little bit of a taker. Like I'll take whatever's out there. You don't have the choices. Like you just take what you need. And then really everybody has this. Every startup founder, every company should have their target customers of who they want. And what we started seeing about 6 to 8 months in is those companies were coming to us, or if we went out to them, they knew what we were offering. And that's when it started clicking. Like it's not just the growth, it's the growth from the companies that you want to grow with long term. And so PMF is, everyone says it's just this like crazy growth hockey stick, which is true, but you can get hockey sticks many ways. You can pay for it. You pay $4 and you show $1 of growth. It's possible, but then it's not sustainable. It's not long term, right? And so I think really what was starting to click about 8 months in, 9 months in, is we were starting to see companies, even today, that are with us, coming to us for the first time, which is companies we wanted to grow with. And that I think is a little bit different than just the initial PMF of like, oh, someone's just coming to us with the cards and using it and we're seeing crazy volume.
Got you. And was there ever a time on the flip side where you actually thought things maybe wouldn't work out and the company might fail?
Yeah. So, I mean, the good news of where we are today is I think we've been through multiple cycles. And I think going back to your earlier point, there are things you control, there are things you don't control. Speaking of things we don't control, one of them was interest rates going up 500% in 12 months. If you think about companies, for instance, in the US that started earlier, they didn't have that environment. They had a 0% interest environment. Very easy, not easy, but like it's easier to build because you don't have the constraint of interest rates going up very fast. And so that was a huge change that happened in 2023, which is now you have this issue where good companies, really good companies, they are also making the same assessment of like, okay, what are we going to look like 12 months from now, 24 months from now? And they're using our products, for the spend. And so we had to make really hard decisions on a couple of fronts. One, what are the type of companies that we want? Do we want small companies? Do we want medium? Do we want enterprise? And we had to turn off companies, which is horrible, right? Because they have been using you. They want to work with you. And you're kind of saying, hey, just at the spend that we have today, like we're not earning enough revenue. We're 200 people. We're not earning enough revenue for us to be able to service you at the level that we need, right? But it's not great. So like that was one point. And then the second one was when we were seeing the interest rates go up and we had to make a decision to turn off anything that was not 30-day cards. So we had a product that was 60-day, 90 days, and we were just like, we're going to turn it off. And that ate a big part of the business. But it was the right call. The reason we're here today and growing and have 80% gross margins, 3 billion TPV, et cetera, was because we made that really hard call in 2023. But there was no guarantee. I mean, that was 23 was a tough cycle. This was pre-AI, right? So it was just like the cycle of like everything's turning off, interest rates are going up, nobody knows what's happening. And then again, the market started changing. Now there's like more optimism, all of this stuff. But 23 was a tough cycle of like we went up, turned it down, then reset, and now we're going back up again.
By the way, how fast did you get to like 1 million in ARR and then 10 million in ARR?
So we did 1 million in about 6 months. And I think we were doing 7 million in a little bit past a year. But again, this was a different cycle, right? So that then turned off and they'll be back again, right? So it's not a one up and a one down. It's a one and a reset. But again, like the thing I would say is what is really good about the 23 cycle is that there's no shortcut to building a sustainable business. What we had to do in 23, we would have had to do at some point, which is get your unit economics under control, build a sustainable business, contribution profit has to be great. There's only so many ways to build a business, or you sell the business and you get a good outcome, which we did in my last company. And what 23 forced you is to do that in 1 year, which usually you would have 2, 3, 4 years to get to that point. It just said you have 12 months, you got to do all these changes and get to that point, or you don't make it. And some companies didn't make it.
And last question, what would be your number one piece of advice for an early stage founder looking for product market fit?
Find one metric that you can breathe, eat, live with, and just like a monkey with a hammer, like just go after that metric. And don't worry about anything else. Don't worry about whether everything else is upside down, but like just that one metric. If it's again TPV, volume, revenue, CAC, whatever it is, just find that one metric and just beat it down, right? Like just completely own it. Because then you also start having confidence. When people never talk about this, but even as a founder, you need to believe that the product is working. And the only way you can believe is if you feel like that one metric you need to run the company you're getting the right traction, the right directionality on that. And the second part there, which is also tied to this, I think founders should focus on the functions that make sense in the beginning. And what I mean is, like, you can only do one thing well at one time. So in the beginning, it might be product. It might be just get your product done. Forget about marketing. You're not going to be good. Forget about this. Like, just do product. Then it might be go to market. Now you just are going to be the go to market person. You have to do product led sales. You go to founder led sales. Get the ball moving. But then at that point, you might not have enough time to focus on marketing. And then as we grew, I'll give you an example. The biggest thing became finance, which is like crazy. You never think about this, but how do you run like a finance, or we brought in a CFO, et cetera. But you can't do all of them. You have to pick one you're going to just be all in on, and then be okay with trading off on the other ones while you just focus on that. And then you juggle, and then you pick the next one, and you juggle, then you pick the next one, and you keep that going.
Awesome, man. Well, Dileep, it's been great having you on the show. Thanks for sharing your story.
Thanks so much, Pablo. I really appreciate it.
Wow, what an episode. You're probably in awe. You're in absolute shock. You're like, that helped me so much. So guess what? Now it's your turn to help someone else. Share the episode in the WhatsApp group you have with founders. Share it on that Slack channel. Send it to your founder friends and help them out. Trust me, they will love you for it.